Thanks very much for the intro. Welcome to this climate summit session. It's called Climate Tech is Too Capital Intensive, but Not Always. And we're at a time right now, if you look around this summit itself, you'll see 4 or 5 other sessions that are really trying to cope with the question of how do we get all this late stage capital for the infrastructure of scaling climate tech. And it feels in our market almost like the government is saying, hey, we funded all of this research at this universities to create these technologies that become these startups. We're so excited that the financial capital system can now scale that for us. Meanwhile, here in early stage venture capital, we funded all these startups and we're looking to the government to say, hey, regulate and fund all of these startups to scale them. And it's almost like a divorced couple who have kids and they both made plans for Saturday night thinking the other person is the one who was going to watch the kids on Saturday night, but the kids are stranded. And we're in that point in our market right now. And this panel, this is a different way of thinking. Think of this as a little safe harbor for another way of looking at this world, which is that not all capital intensive companies, not all climate companies are this capital intensive. They are out there. We want you to know that they exist, and there's a different way of doing this. And most of all, what we're looking to bring is to eliminate this jadedness, this idea that you shouldn't even look at investing in climate tech because you assume all of it is too capital intensive. There are other ways to do this. The primary way has been to invest in software or sensor companies that use normal tools of big tech and their margins. But there's also a new way emerging, and I brought some panelists together to try to air this out. I'm very excited about them. Each of them has a different point of view here. I brought Josh Silverman, who's the CEO of Windfall, but he's also a multi-time founder over many years here in Silicon Valley. And he's been through a lot, and I think his personal maturation through this and how that's resulted in the business model of Windfall is an interesting thing. I've also brought Nicola from Coca-Cola Europacific Partners. It's often thought that CVCs are pretty fine with all this huge CapEx that these startups are wanting to talk about when they partner with large corporates. But I've watched Nicola work and I've watched what they've been investing in, and I see actually a really interesting point of view there from the point of view of corporates. And lastly, to really bring something different to the table, I've got Akshat Rathi, who is, most of you know, is the Bloomberg news reporter on covering the climate beat, always posting really interesting things and doing significant stories. And he has a new book, Climate Capitalism, which isn't normally for like this particular audience. It's really to speak to the whole world out there that is trying to figure out like how do capitalism and government subsidies work together to solve climate. So I welcome the three of you, Josh, Nicola, and Akshat. And I'll start with Nicola. I'm going to start with you, if you can. First tell people a little bit about Coca-Cola Europacific Partners, how it fits into the overall Coke ecosystem, if you could, and maybe share a few things that you think of about like how you're looking at low-capex modular systems that don't have the massive upfront capital costs that so many other things in climate do.
Sure. So for those of you that don't know, then Coca-Cola Europacific Partners is a bottling partner of the Coca-Cola company. So that means that in the territories in which we operate, we're responsible for sourcing raw materials, we own the factories, we ship the product, we sell to end consumers. And our ventures department has been set up specifically to invest in really early stage climate tech that is going to help us get to net zero. And the reason that we invest is because we have a commitment to reach net zero, and we know that we're not going to get there with existing technology. And therefore, we feel like we have a responsibility to help these technologies get to market and therefore help us reach net zero. And I'm really excited that you asked us to be on this panel because we quite often hear people say exactly that. Climate tech is expensive, we're adding cost, it's narrowing margins. And actually, I think that's a myth in a lot of cases. You know, climate tech does not have to be expensive. It doesn't have to add cost. And all of the things that we've invested in so far, we're looking for solutions that have a positive impact on the planet, without adding cost into our business. And you touched on modularity there. We've seen that play a big role in how these things can work. So let's give an example of direct air capture, which is something that we've been heavily interested in. And when you think of direct air capture traditionally, you think of megaton factories out in Iceland or in big direct air capture hubs.
Yeah, huge giant sucking machines that are like gonna fill the skies. And we're gonna need, like, everywhere there's a gas station, we'll need this huge industrial CO2 sucking machine. Yeah.
Yeah, and they're ginormous, and they've played a really good role. And I do think they have a role to play if they can meet the energy requirements and bring costs down. And, for Coca-Cola, we use carbon dioxide as an ingredient. So there's things that you can do with it without having to push it underground. There's things that you can do to make carbon dioxide circular. But you have to be a bit more clever with the model, because this ginormous, centralized system just is really too CapEx intensive and doesn't work. But we've invested in 2 direct air capture companies. One of them is a UK company called AirHive. And the reason we invested is because they were offering a modular solution that would allow us to put something on our production sites, capture the CO2 from the atmosphere, and then use that ingredient directly at the point of withdrawing it as an ingredient in our drinks to make the fizz, to put the bubbles in the product. And they're using, off-the-shelf equipment that they have integrated their IP into to create something that isn't massively CapEx intensive. And if you look at the lifetime of the CapEx and of the product that they provide, long-term with good renewable energy prices, we believe that they'll be able to meet the current cost of CO2 for us, even taking into account the CapEx cost.
That's great. And just for the audience watching, this wasn't so much a Coca-Cola problem, but during the World Cup, basically Europe ran out of beer because it didn't have the CO2 to inject into the beer. And it was a CO2 shortage at a time we had CO2 everywhere in our world, Okay, that's awesome. I appreciate you bringing this point of view. I would just try to get other people in. So Josh, I'm going to go to you. For the audience that doesn't know Windfall, please tell them just a little bit about it. But then I'd love to hear about the business model through the context of your history with experience over different startups, and why the business model Windfall is what it is.
Yeah. No, thanks, Bo, and thanks very much for having us on, being able to talk about our technology. So, Windfall Bio is a nature-based company. We focus on the capture of methane, not CO2. And so one of the things I definitely want to make sure the audience understands, right? Methane is a significant climate gas. It's causing somewhere between 30 to 50% of the actual warming of the atmosphere today. And yet so much of our conversation is on CO2, has been about CO2. And yet, methane, up to 50% of the actual warming of the atmosphere, is getting less than 2% of climate investment and focus in the climate. I think the other major difference that relates very much to this conversation we're having today. So, CO2 is the lowest energy form of carbon. It's the end product of combustion. Anything you do to CO2 to capture it, concentrate it, sequester it, transform it, everything requires energy, because everything is uphill thermodynamically. And energy is expensive. I mean, that's the one thing I think everybody can agree on. All right, if it takes energy, it's a cost. And that's why we keep talking about climate technologies as cost centers, because you have to pay for that energy somewhere. That the benefit of methane, while again, it's a significantly worse greenhouse gas than CO2, methane has energy. Right? Methane is the highest energy naturally occurring form of carbon. If I have enough methane today, I can put it in a pipeline and get paid for it, right? I can burn it, I can turn it into electricity. Methane has more than enough energy contained in the molecule to actually drive its own capture, and with energy left to spare to create value. There's a reason natural gas is a currency of energy all around the world and is used that way, all right? And it is a value add and is extracted and used for that value. So our technology basically focuses on that value within the methane molecule. And by capturing methane, preventing it going from the atmosphere, and using that energy, we don't create cost centers for people to remove a climate gas. We're actually creating value add capture of a resource that's currently wasted for them. And so our technology is a biological system. These are naturally occurring non-GMO microbes that eat methane as their source of carbon and energy. So in the same way that yeast eat sugar to produce beer, our microbes eat methane and produce high-value nutrients and fertilizers and soil amendments that create value for our customers. So our model is very much in this sort of very low capex, very low, very high modularity, very distributed, partly because the methane sources that we look at are distributed. I mean, the whole idea of stranded methane is methane out in the middle of nowhere, and sort of by definition, these are small, low-quality sources of methane, because if it is a high-quality, concentrated source of methane, someone has already put it in a pipeline and is getting paid for it, right? That value is already there. So it's a bit of a circular definition in that regard. But in that same vein, we have to adapt our technology to be small-scale, capex light, and modular, because it has to fit with the source of the feedstock that we're going after, and has to pay back on a very small scale, which is not how we normally think about big climate investments. And just to touch on the second part of your question, Pose, so my experience, so I was a founder at two large climate-based companies, first Siluria, then Callista. Both of those were focused on natural gas transformation, and both involved the building of $100 million large stainless steel plants to develop the technology. And both were technically successful. We built the plants, they operated, they met their specs. But it's a really, really hard road. And we kept getting into this catch-22 of building the plant, where in order to secure the financing for the plant, you have to get guaranteed offtake contracts for the products coming out the back end. Nobody wants to give you a contract, a guaranteed offtake on the product until they can see, thousands of tons of product coming out, and you can't produce thousands of tons until you finance the plant.
Yeah.
End up in
chicken and egg dynamic, or
chicken and egg. It's the valley of death. You can call it. We've heard it called over and over, all these different things, but it's just a catch-22 where, again, if you have to pay hundreds of millions of dollars, it just becomes a massive blocker, regardless of how good the model is for what the profitability might be at some point in the future. And then when we start talking about how do we scale things to something that's going to actually affect the planet, the climate as a whole, like if your capex, if it's anything more than zero, right? You multiply the trillions of tons and cubic meters of atmosphere that we have to deal with and treat. If you're multiplying that by a capex number that's anything more than zero, right? Trillions times any number becomes a really, really large number. And then the question is, where does that actually come from? And the reality is, nobody has trillions of, on paper, you can write it out, an economic model says, oh, sure, just raise $1 trillion. The reality is that doesn't exist. No one's done it, and it's very unlikely to happen. Where as a centralized single investment with a large payer, the things that do scale to those levels are things like your small modular biological systems, things like crops, planting trees, agriculture, rainforest. Like, these are self-perpetuating, cheap systems that sit there, do what they do without significant amounts of capex and opex, and scale horizontally, not vertically. So they're not capital intensive, but they're self-perpetuating catalytic systems. And people, I talk to chemical engineers, and they say, well, biology doesn't scale. And biology doesn't scale in the same way that we think about, again, the big sucking carbon plants that you talked about, right? But biology is still the single largest sink of CO2 on the planet. And the thing is, it has scaled. It's already scaled. It is the largest scale technology in the world. And it's just, we can't scale trees more than we already have. The available area that we have has already been saturated, so we can't scale more. That doesn't mean that technologies like what we use for capture of methane can't now scale, because they haven't had the same chance that trees have had. So
yeah, great.
I'll stop there. But yeah.
And fabulous. And one of the best approaches to describe Windfall I've ever heard, and I've known you for 2 years every time. Just real quick, for the audience's benefit, share of methane, like how much of our methane challenge is in these dilute forms, distributed dilute versus in concentrated? Like, is that a big part of methane, a small part of
No,
methane?
it is huge. 90% plus of the methane going to the atmosphere is not coming from concentrated. Like Nord Stream pipeline blew up. A whole bunch of methane went into the air. All right, and you could see the bubbles on the ocean, and you could see all this methane pouring out. Those are fortunately rare and unlikely events. Where we see the vast majority of the methane, it's coming from places like landfills, from wastewater treatment plants, from rice paddies, from cows and manure, from natural wetlands. Right, these are all low quality, less than 5% concentration methane, not combustible. Right, if you have a pipeline and you have excess methane, there's a real easy solution. Right, you light a match. Right, or you close the leak and you get it back in the pipeline and you burn it somewhere else. Any methane that gets into the atmosphere over a 20-year period is worth 86 tons of CO2 equivalents in terms of impact to climate. So burning it to CO2 is absolutely, it's a huge advantage. It's a huge win. But I come back to, again, methane has value. So if we were talking about concentrated methane, and again that the pipeline is dumping methane into the air, there's a real strong incentive to close that up and get that somewhere else because people are going to get paid for it.
Okay, let me go to our third panelist here. So Akshat Rathi, welcome to the SOSV Climate Summit. As a former journalist myself, still book writer, excited to have another one here. And I'll first tell people about your book, and I'm really curious your point of view you have to share here, where we have the audience today of the very VCs that are trying to be capitalists in this space.
Yes. Well, thanks for having me. The book is about trying to do exactly what we all want to do, which is showing where in the world climate solutions are being deployed at scale, at a country level, at a company level, at an industry level. And it is really around the world. And so it's covering examples in the US and Europe, but also in India and China and in some small island countries. So what I found in that process is that you do require people, policy, and technology to come together, but none of that happens without finance. And that's what we are talking about today. Now, I'm going to challenge the premise to say, are there only capital light solutions that we can go after? There are certainly many, and we should. And we talked about a couple of them that Nicola and Josh talked about. But I would say also the other way to think about this is that when we're talking about capital light, we are really thinking about it from the perspective of the startup or the investors in the startup who want to be capital light. It does not mean that the end product has to be capital light, right? So there are a couple of ways in which companies have been able to use or stay capital light on their own, or investors don't put up that much of their own money, but bring in multiplying money from elsewhere. One model that's been used and will continue to be used is a licensing model, where you are making something that has a manufacturability that fits in an existing manufacturing setup, and you license your technology. This is happening more and more in battery manufacturing. If you're able to provide a drop-in solution for a current battery manufacturing setup, but that improves the energy capacity of the battery, or reduces the cost of the manufacturing material that you're using right now, or reduces the amount of energy you have to use to make that battery, then please, we'll happily take that license from you. We'll give you revenue from the start. We'll get some of your people to work in our big battery company and make that startup really be scalable. And then you're not looking at a Series B and a C because you've got revenue coming. You are spending that revenue on R&D and you're working on licensing. And that's, I'm picking a battery example there, but there are a few more areas where this is taking off. The other one, and I think why I was challenging the premise of capital, is that eventually we are going to need large-scale solutions. That there is no way around having large capital going towards these solutions. But that large capital is relative to where we are sitting today, right? Today we're spending about less than $2 trillion on the energy transition globally. We need to spend at least double that if we want to be on track for net zero. So doubling that in the trillions, as Josh was saying, is hard, but we are already at 2 trillion. So we only need to double now. It's not sort of a 2 billion to 2 trillion leap that you have to take. So one place where I found solutions that are starting to take off and where investors who are listening can actually really push for that multiplicator factor to come through is to invest in developing countries. So there are two ways in which you can think about this. One, you could think about actually doing your demonstration in a developing country where your material costs are lower, your labor costs are lower. I have met multiple founders who are from developing countries. I know a founder in India who's currently got a company in San Francisco, but wants to build their first factory in India because it's just a capital light place to go and build their first factory. But the other one is to actually engage with the financial system that's going to bring in the trillions of dollars. And so, these banks, these large investors beyond the VC have the capital, they have the desire to go into emerging markets and in green solutions, but there is a gap between where they are and where the startup is and where this money needs to go. So places that can help that translation happen is through development banks. There are a ton of development banks here in the US, but also in Europe, in Asia, which will work with a startup and a large financial institution and bridge that gap and provide sort of risk-free capital in the middle where they'll say, if this startup goes down, we will absorb all the losses and you, the large investor, doesn't have to worry. But you do have to put in a larger sum so that you can help the startup actually scale up. So these types of, they're called blended finance instruments. They are becoming more and more the way in which global climate diplomacy is talking about moving capital to developing countries. And I think investors can play a big role all the way starting from VC investors at early stage capital, at early stage companies.
So you're describing VCs funding technological risk, team execution, that kind of thing. And then it's paired with development banks that are really focused on developing world and bringing together almost these different extreme sides of capitalism into a single sandwich and making it work. It does create a challenge, which is that's a long cycle to get a development bank to want to fund something. It's a long cycle to get a nation to say, we need this technology, as much as we realized back in the day we needed solar type of thing, because there are just so many of them.
Yeah, I mean, there are a couple of examples that I can bring up which might help. So I think most people would probably be aware of things that Breakthrough Energy has done with its demonstration units through its capital funds, where they may not be investors in the startup, but they are helping create the first demonstration plant through bringing in corporate money and other types of capital. Right now, no development bank is involved, but the other place where this is happening is there are certain types of technologies that developing countries want that you could go and actually build there. So Singapore is a very good example of lab-grown meat, for example. Chicken now is legally, you can go out to it in a shop and buy lab-grown chicken in Singapore, because Singapore does not have land, does not have much of food security, and it wants to be able to create those technologies in us. So there are real opportunities for certain types of technologies where governments are actually waiting for startups to show up.
Yeah, it's good. It's been a whole... Nicola, let me ask you, we've talked about modularity. Akshat has brought up, Josh talked about self-perpetuating. We talked about manufacturability, some here. And then there's been this talk about like how to maybe free ride on existing infrastructure. Like if you want to do something to seawater, look for where there's already infrastructure with seawater in it. For example, power plants use seawater to cool them all over the world. And if you want to get access to seawater without just get inside a power plant kind of thing. So what are some of the other like features that low capex companies like are hallmarks of their financial pattern that you look for to even just separate them from the heavy capex companies?
Yeah, okay. So Akshat mentioned as well about drop-in replacements for things. So we're looking for companies that can create a renewable chemical or something that can drop into existing infrastructure that prevents them having to do the capex in the first place. So we look at it a lot from a recycling point of view. We look a lot at plastic recycling, and what companies out there are not requiring huge infrastructural changes, but actually can provide a monomer or a PET resin that drops into existing infrastructure for us to use. And they're really useful because you're looking at what works today and currently and how can we better utilize it to prevent CapEx. But I also think you can be really smart and think totally differently. So if we look at ingredients for us, ingredients are 25% of our carbon footprint. We need to reduce our reliance on sugar, for example, and we need to look at how we can make sugar more sustainable. And the obvious way to look at doing that is to say, okay, what creates the carbon footprint in sugar? Okay, it's the fertilizer, it's the pesticides, it's the diesel from the tractors. There's all these things. And what you could do is go out and tackle each one of those individually and say, okay, we're going to create a green fertilizer, but it requires loads of CapEx because you're changing the systems. Or you could switch the tractors away from diesel, but again, you're looking at more equipment, more infrastructure. Or you could, and pardon the pun, but you could look at the root of the problem, So actually, could we just have a crop that doesn't need as much fertilizer, doesn't require the tractor to go over and spray pesticides quite so often? And we've invested in a US company called Avalo that's doing just that. They're using a software model, they're using an advanced AI tool that allows them to track and identify the traits within a sugarcane crop that would make it require less inputs, make it more sustainable. And once they manage to do that, they're tackling multiple things all at once. They're dropping into existing infrastructure, but they're adding value across the value chain as well, because farmers are having to use less inputs, so they're making more profit. They're being able to sell their product on without having to put an additional on cost onto the end consumer as well. So it's not only low capex, but it's increasing the value pool for everybody.
Yeah, and Avalo, which is in addition to sugarcane, also doing cotton, is, doesn't need to own farms. They'll just take farm debt, pay the farmers to grow their cotton and in the future their sugarcane, and then 5 months later, pay back the farm debt. It's very low interest debt because essentially farmers are subsidized all over the world and doesn't necessarily need CapEx in that system. It's a really ingenious train of thought about an elegant solution to what could look like a multi-piece problem. And Josh, let me ask you this. Often we see these companies that are like one-upping each other in a space, and every year they're like, we do what that company last year did, but we also do this, so it's cheaper. You seem to be more of a first of its kind company, and often first of its kind companies didn't really have all this worked out. Like, in the methane space, there was sort of a paucity of people trying to solve the problem you were solving, which is all this dilute methane in the world.
Yeah, and I'd say there still is. So not to jump in too much, but yeah, we would absolutely love to see more people work in the methane space. It's still massively underpopulated relative to its impact on the planet. I did just want to jump in on the drop-in replacement side of things. I mean, so we've talked to a lot of players, and I would argue there is no such thing as a drop-in replacement. There is always going to be a switching cost. There's always little details. Just the contaminant profile, the less than 1% contaminant profiles that show up in a new ingredient can often require pretty big changes. So every time we talk to a large customer, there is a lot of work that goes in. And when we think about CapEx and our customers think about CapEx, I think the one thing that I haven't heard yet that I did want to highlight is that there is an opportunity cost. And so even if your new technology on paper makes money, even if it is profitable and looks good, like every large customer that's coming to you, they have $10 of CapEx to spend. The choice is, do I spend it on this new technology that has a high risk, or do I spend it on this other thing that I've always been doing before, is very low risk, and I know exactly what the return is? And that opportunity cost with these companies have limited CapEx budgets, they have limited bandwidth, they have limited opportunity to do anything. And so trying to get something new has to, it is a very big hurdle. And that's something that
it's competitive. It's a competitive market, and all these opportunities are looking for this capital. Akshat, you talk about Breakthrough Energy Ventures investor and Josh, and I'm on cap tables with them, but like it's competitive to get in there, So Akshat, like your big picture, you travel the world promoting this stuff. You're well outside the normal VC ecosystem. Any final words for us here to think about this topic?
I would say just watching it from a distance, climate tech has gone through two big cycles. The first time around, the crash was quite real and real bad. This time around, there certainly has been difficulties, but it's nothing like the last time. The struggle is real. Don't get me wrong, but there's also so much potential because the rest of the world understands this problem much better than it did the first time around. And so as much as there is challenges to be faced, both on capital, but on all other things, this time around, the world is way more committed to actually addressing the problem. And that should give investors, but also all the startup founders a lot of hope.
Thank you. Yes, I appreciate that. Yes, people are committed. You can hear from Nicola talking about the responsibility for net zero. It's very, very real. It's felt by everybody. It's shared and it's durable. Panelists, thank you very much. I wish we could spend another half an hour talking about this, but I will pass it back to SOSV.